But Pankaj Tibrewal is joining in. He is the founder and CIO of IKIGAI Asset Manager. Pankaj, hi, good morning and good to see you in on the show. The market has been very, very strong and, has rewarded a lot of long-term retail investors. But what now? Most of the triggers are behind us, including triggers like, the union budget. Now, of course, there's expectations of rate cuts as well from the Fed. But going forward, how are you approaching the markets?
Good morning, Sonia. If you look at one of the primary reasons of the kind of strength we are seeing in the market is the fundamental earnings growth for the last 2 years, which we saw from FY22 to FY24. However, we believe that the first quarter has started on a very muted note. If you look at the 175 companies out of the NSE 500 companies, which have declared results till day before yesterday, the numbers are not very encouraging. If you look at the headline numbers, it's 6% earnings growth. But if you bifurcate into two parts, 58 companies, which are BFSI companies, they have delivered 27% earnings growth. But the 118 companies, which are non-BFSI companies, which is largely the broader market, they have delivered negative 8% earnings growth. So the idea is that the earnings growth has started to slow down. And our sense is this year it will be a 10 to 12% earnings growth for the broader market as a whole. And that, I think, should weigh on the overall market movement at some point of time. Second, if you look at Nifty also, 30 companies in Nifty have reported, and it's a flattish earnings growth. And if you again bifurcate between BFSI and non-BFSI have seen negative earnings growth. It's BFSI which is pulling up the earnings growth. So we believe that earnings momentum is slowing down. Margin lever, which was the main contribution of earnings growth last year, is receding. And hence we need to be very careful in the markets because there are certain pockets which are full of exuberance. For example, look at the railways and defense as a total market cap. It's now about 18 lakh crores. FY19, this total combination was 1.2 lakh crores, which is about 67% CAGR in market cap. But the profits have grown at 21% CAGR. So certain times in markets, you need to be careful of what not to do. And I think the elimination method works the best. This is the time in the market where you need to be absolutely clear what to avoid and what not to invest in. And I think if you can navigate this over the next 12 to 18 months, I think you should be okay. So I think we need to be careful in the markets in terms of stock picking.
No, that's very well put. What not to do is also a decision, right? And what to do, of course, is one. Pankaj, hi, morning. Always great to speak with you. So I think we get a sense of what not to do from you, right? I mean, you cited that stunning statistics, almost 70% CAGR in market cap of those two sectors from 19 onwards. But money is still coming in and you being handed money from investors at IKIGAI. So you got to put that to work as well. So let's talk about what can one do and, what should one do, Pankaj? Sectors and themes, etc. You're still comfortable with?
Prashant, I think one sector which is seeing reversion of margins is consumer durables. I think we saw a very strong summer and the ground feedback is that there is decent demand uptick across the board, whether it be smaller appliances or larger appliances. And the industry profitability pool is at a decadal low. So we believe that this year you could see margin reversion in certain consumer segments, whether it be discretionary, durables, or in terms of FMCG as well. The second is pharma. I think we continue to remain positive on the US generic space plus the domestic space. And there are certain pockets like CDMOs. In our view, that's probably a next 2 to 3 year story. And if the law gets passed in US, which restricts the imports from China on CDMO and others, I think Indian players have a very long runway of growth. So that's another segment which is looking good. Financials, I think, is reasonably valued, especially the public, private sector banks. And I think given their franchise and the long runway for growth, I think after a long time, you are getting few of the good franchises at very reasonable valuations. Fourth, I think auto ancillaries is another very interesting space because what we are seeing in certain auto ancillaries is the texture of the company is changing for good. All this while they were dependent on auto sectors, whether it be two-wheeler, four-wheelers, or commercial vehicles. But certain auto and companies have also pivoted themselves to industrials. And in many cases, 30 to 50% of their incremental revenue is coming from industrial sector, which is seeing decent growth, and they have a right to win. So I think auto ancillary selectively also is looking good. And last but not the least, metal prices are at intra-year low. We believe that there could be a case as a contra call to look at metals as a sector. I believe that the prices across the board, whether it be ferrous and non-ferrous, have fallen across, and valuations are reasonable if you look at some of the companies from a capacity perspective. So these will be the few sectors, I think, where one can deploy incremental capital. But again, I repeat, it will be a stock pickers market. I believe the breadth of the market has started to narrow down. Only 40 to 45% of mid and small cap companies have been able to outperform the index, which is the first sign that market has started to differentiate between companies. So I believe that this next 12 months, be careful in terms of picking up stocks, and it's a stock pickers market.
Okay, all right. Hi, Pankaj. Good morning. Always good to see you again. So it looks like the easy money has been made. Now you'll have to work a little bit harder or a lot more harder from here on to make some money, going by earnings, going by the, the entire investment scenario. Let's talk about, you briefly spoke about metals. Let's talk about cement. What are you making of this entire consolidation that we are seeing? In the near term, there could be pain on prices, which will reflect on profitability as well. But it seems the street is more focused on maybe 4 or 5 big players in the times to come, and the large will get larger, which will be a longer term positive. Your take?
Yeah, Nigel, absolutely you're right. This is a consolidation phase, and our sense is that the top 5, 6 players will command more than 60% market share in India. And that's happening region-wise. If you look at South, the latest move by Ultratech is a welcoming step, and there's a significant consolidation which is happening in South as well. And over the last decade or so, we have seen 200 million tons of cement capacity change hands, which is worth about $25 to $30 billion. And I think more is on the anvil, the way things are moving around. And we believe that once the consolidation phase is behind us, the cement prices have not really reacted. If you look at the CAGR of cement prices, it's about 1 to 2% over the last decade, which is lower than the inflation rate. So I think there's a long runway. Once the consolidation phase gets over the next 1 or 2 years, I think you will see cement prices inching up. So companies which are very strong on cost curve, companies which have a good brand where they command premium, and also the balance sheet is in good shape, I think will be the companies to bet on. So if you take a 3 to 5 year view, cement is in a very sweet spot. And we believe that the demand growth can outpace supply growth over a period of time. And don't forget, limestone is not in abundance. There are only few pockets in India where limestone is available, and that will become bottleneck from an incremental supply perspective. So keep that in mind. And I think if one is patient enough, this sector can be rewarding over a 3-5 year period.
The other space I wanted to talk to you about, Pankaj, was autos, because, come Friday, we have the Ola Electric IPO, and this one is gaining a lot of traction purely because it's the first pure play electric two-wheeler, manufacturer that will be listing on the exchanges. But we do know that Ola has its own fair share of problems, whether it's higher losses, higher attrition, all of that, right? So in that space, the electric two-wheeler space, do you think it makes more sense to stick to the listed players despite them having lower market share, or is this an IPO that you would be interested in?
Sonia, rather than commenting on stock specific, I think let's look at the trend. I think over the last 5-6 years, EV globally has been a talking point. We have seen changes, and the changes will happen over a period of time as you move and pivot from fossil fuels to EVs. But last 12 months to 18 months, if you look at, there's been a significant change. Toyota is one of the best performing auto stocks, and they have never pivoted themselves to EV. They never believed in that thought. And they've always said that hybrid is the way to go. On the other hand, some of the EV makers across China and US are having troubles when you look at their stock prices and in terms of volume growth. So clearly the change is there on the canvas, but the change may not be as fast as the markets were expecting a couple of years back. So I think ICE is there to stay. And we believe that there are certain companies which have significant, market share in this space. And people were giving a negative terminal value to them, say a couple of years back, which has changed now. And I think both will coexist as we move ahead. And the change may not be as fast as what the markets were expecting. So I believe that having a right combination in the portfolio of both the ICE engine companies as well as the EV, players will be the right strategy rather than either or all.
Pankaj, just a few points. So consumer durables, so buy the brand or buy one of these sort of EMS companies. That is one. Auto ancillaries, are we talking about sort of bearing companies? I mean, if you could give us some sense without actually not as stock recommendations. And metals, what exactly? Are we talking about steel in particular that you like?
So Prashant, I think on the durable side, we believe the companies with strong brands can do well. And we are seeing in certain cases market share wins. And my broader thesis is that the industry profitability is at a decadal low. And there could be reversion in margins as competitive intensity starts to come down in certain pockets, which we are started to see. Second point is on the EMS space, you need to be very careful that many companies are not generating operating cash. So they are trading between 20 to 30,000 crore market cap. But when you look at the cumulative operating cash flow of the last 4 to 5 years, it's flat to negative. And I get very worried when I see companies with only earnings growth but no cash flow. Finally, top line is vanity, bottom line is sanity, and cash in bank is reality. And if companies without cash flow and only growth are recipe for disaster. So one need to be careful on those companies which are not generating cash flows on EMS space because these are wafer thin margin businesses. Second, on your point on metals. Yeah, on metals, I think certain companies, both on steel and non-ferrous, probably are looking good if you take a 2-3 year perspective. And we are seeing that incremental return on capital on some of these names are in double digits, which is very, very encouraging because they will like to sweat the assets on the capex done over the last couple of years. And steel and non-ferrous, especially aluminum, looks to be in a decent space.
And auto ancillaries, if you can go one step down.
And auto ancillaries, in terms of auto ancillaries, we believe that, as I said, there are certain companies which are changing in terms of business competition. We are very excited about those few companies where industrial is also becoming an important component apart from autos. So there are certain companies which are catering to aerospace, defense, which are catering to wind, which are catering to renewables. And I think once you start moving into that, you have a balanced portfolio on both the autos as well as non-autos. And some of them are also pivoting themselves to engine agnostic technologies. So whether it be ICE or EV, which time will only suggest which one is the winner, but they will be riding on both. So I think that terminal value concept of the terminal value question may not come true for a few of them. So we are also looking at few of the auto names on that side.
And sort of just share your thinking on this entire power space as well, Pankaj, if you will. NTPC had that analyst meet yesterday. Market's very excited. There's that renewable play in it, and there's, of course, a runway for thermal expansion as well. So just your thoughts.
Prashant, I think power is a decadal story, not only in India, but globally. Look at few of the data points. For 20 years, power demand in US was flat. And suddenly over the last few years, you have seen a very sharp increase. Why? Because for everything you need incrementally, you need electricity. Whether it be Bitcoin, whether it be electric vehicles or electric anything onto EV side, or whether it be data centers. And what used to happen earlier globally was the large amount of power used to get consumed when a big steel plant used to come, when a big aluminum plant used to come. which used to take 3-5 years, and you could have planned your supply accordingly on power. But now data centers take 8 to 12 months, and so many other consumption of power takes very little time. So you have to match the supply according to the demand. And renewables are doing that. But the problem is on transmission. Globally, the grid is, choco-blocked, and especially in India also, if you look at, the day power rates in northern India is higher. The day power rates across and an average in India is 2 rupees, but in northern India is higher. What does it suggest? That the transmission is not happening. And I think a large part of investment globally and in India over a period of time has to move into transmission to make sure that electricity travels across the board. And in my view, over the next 5-10 years, power as a value chain can throw a lot of winners. We need to be careful because a lot of them are pricing and they are pricing and valuation. That's the only challenge. But if you take a macro construct, I think globally there's a demand which is increasing in power and supply is not catching pace. And the bigger issue is transmission. I think the grid is choco-blocked across and we need significant incremental investments. That's why I was not very surprised when Power Grid at their analyst meet yesterday upgraded the guidance on capex from 15,000 crores to 18,000 crores. And I think India needs significant amount of investment on the transmission side.
Okay, all right. Macro opportunity is there, definitely. But what about stock-specific opportunity and how much is in the price? That's always the question. Pankaj, great to have you with us here. Thank you very much for your time. Appreciate it.